and look at the peer group, what we're talking about. Okay, so I can now see all of you also. So, JK Cement or Shri Cement, 72.90. So it means two things, Again, Shri Cement may be having a very good growth compared to the industry. So that's why it is, valued higher than the industry. The industry's median P is just 49, whereas, Shri Cement has almost double the ratio of the industry, which is 72.90. Okay. So that means its growth prospects it is growing at a much faster pace compared to all companies. So that can be the reason. Or it is, overvalued. So we'll come to know how do we know that basically, okay? Because the P ratio will not tell you everything. So we need to calculate the growth and calculate another ratio, which is called the PEG ratio. Like similarly, like ACC is 14.71. It is undervalued compared to the industry. So that means the growth prospect of ACC is not so good. Okay. So how do we know that? So let's now go to that part of our understanding. So here we just enter and go at the bottom. Okay. So we have the growth in earning per share. So we need to fill up this growth. Okay. In 24, what was the earning per share? What was the earning per share in 25, 26, 27? Okay. So I'm just opening, the sheet which I have filled so that, uh, okay. So I'm just opening the sheet here, okay, which I have already filled up. Okay. So if you look at the growth in earning per share of Ultratech, okay. So what we are going to enter the numbers. What is the earning per share of in 2024? What is the earning per share? Because 2025 is already gone by. 2026, how much the company is going to earn? In 2027, how much the company is going to earn? Okay, so we need to have these numbers. Okay, fine. So what we do is that we go to a site which gives you the numbers. So the site name is Trading View. Okay, so go to this site. Okay, and then go to markets. Okay, can you see Ultratech? Then we go to the forecast
Yes, sir.
in Ultratech. Okay, and go straight away down here, and you have the earning per share of the company. Okay, and go to the annual. Okay, go to the annual tab. So it will tell you that what is going to be the share of this thing EPS of the company of Ultra Tech. Okay, so it was like the numbers are given 2025 because these numbers will keep changing. Okay, because the analysts are doing it every week. They are making a change to these numbers. Okay, so 2024 it was 208. Now if you can see, there is a reported number and there is an estimate number. So this is what the number which the analysts have estimated, and this is the number what the company reported. So if you look at the last so many years, 1, 2, 3, 4, 5, 6, so two times the company has actually reported more number than what the analysts were anticipating. So it has beaten the street about two times out of the four times. So in the last year, 2024, it got 6% lower. The estimate was 2021 earning per share, but the company reported 208. Okay. So there were negative surprises coming in the last year. In 2023 also there was a negative surprise slightly. The reported number was 244, whereas the estimate number was 247. So we are going to pick up these numbers and plug our numbers there. Okay. So like 468.69. So what I'm doing is I'll just plug in a number there. Okay. So 469. So it is 474 earlier. So it is now 469. So number has been downgraded. So 2026. What is the number in 2026? The number is 401.79. So we take 402, 402, 402. Okay. 2025, the number would have been the same because the number is already declared. So let's just check. It is 2000 was 314, and 314, so number has not been reported. So 314 is the number. So 314. So we take it here. 314. So which is there? 314. Okay. 2024, it is 208. This is the old number, so which has been already reported. So the number would be okay. 208.25. So here number will be the exact reported number. Rest will be all estimated numbers which you're going to take. Okay. Fine. So once we have done this for all the companies, so what we'll do that we will find out the growth. Now growth is, in number has been, like this number is, if you see the formula here, so it is basically the difference between the two numbers. So there was a 51% increase in the profit of Ultratech compared to 2025 to 2024. So similarly, if you look at that profit is going to be 402 against 314. So company is expecting to increase the profit by 28%. And in 27, it is 17% as per the estimate. Okay, fine. So then we can just take the average of everything. Okay. And then we have this number 31.82. Okay, fine. So what we can do is that we can just plug in all these numbers in our new file, which we have made. Fine. So then what we can do is that we can plug in the number here, the growth here. Okay. So growth we will be capturing here from. So the growth will be 31.82. Now in this column, what I have done is that I have excluded the percentage sign. Okay. So that we can show the growth only in terms of number. So percentage has been removed here at the bottom. It was 31.82. So this was the formula through which we have removed the percentage. Okay. And picked up the number here. Okay. Then what we have done is we have calculated the PEG ratio. Okay. Which is P ratio divided by growth. So it is 1.17. So what does it mean? That, if the company a PEG ratio is 1 or below 1, suppose it is below 1. Now 1 or below is 1 is, ideal number. That means the company is rightly valued. But any number above 1, that means the company is overvalued. So here the company is trading at a premium to its growth as compared to the number was, less. Then we say that the company is trading at a discount to its growth. So here, still after applying the PEG ratio, considering the future growth, now the company's P ratio is 54.3, which is higher than the industry. But when we factor in the growth which the company is going to earn in the next year or next 3 years, so we find the PEG ratio is 1.71, which is still higher than 1. Okay, signaling that the company is, trading at a higher valuation, even when we look at its growth prospects in the next 1 year. Now, there can be a view that don't buy it with this. Okay, so we can say, either hold or sell. Okay, fine. So I'm saying sell at the moment. Okay, so in the last column, you say sell because the company is trading at a higher PEG ratio. One would say invest, but we have to enter the beta and the standard deviation to complete the story. Have you followed now? The growth. Now, so let's go back to the growth again here. And how we arrived the growth? We went to a site and picked up the earning per share from the site. Okay. Now you will say that, we have taken, 3 years average number and we have taken the average, and the growth is tapering down from 51 to 28 to 17. Okay. Is this the ideal way of calculating the future growth? So, what I did was I checked up, from the AI, and than what I got from there. So I just shared this, how the analyst calculate the growth. How do the analysts calculate the growth, okay, of the company? Now, what is our PEG ratio? Just read this summary. Mananya, can you read? So we are going to have a break after this, okay? Can you read this? सबके माइक खराब हो गए. Shrishti, are you there? Ashwin, are you there? Who is there?
Yes, sir.
Shrishti, just read.
Srishti. Yes, sir. What PEG ratio is? The PEG ratio, price by earnings to growth, is a valuation metric that adjusts the traditional PE ratio by factoring in the company's expected
Okay.
growth rate. PE is equal to current price divided by earnings per share, and growth rate is equal to expected annual EPS growth, usually over 3 to 5
Okay.
years,
So that means we have done
sometimes
for
1 year.
almost like 2 or 3 years. Okay. Okay. Now, just read the here. Yeah.
How growth is calculated. For PEG, growth is based on EPS growth rates, not revenue growth unless explicitly stated. Looking at your Ultratech EPS data, step 1, identify EPS values from the chart reported in estimates in INR for 2023 and then 2024 to 2027 estimated. Step 2, calculate CAGR. CAGR smooths out annual fluctuations and gives
Okay.
the
So
average
now
yearly
this is the
growth rate.
formula what is used by the analyst. So what they do is basically they take the growth EPS initial, EPS final upon initial, and the number of years which you have taken. Okay. How many? So it is basically the CAGR smooths out the annual fluctuation and gives the average yearly growth. So the last year data is 473 and the initial was 208. Okay. If you look at here, so we have taken the initial as 204, which was the estimated. Okay. Fine. And the last was 473. Of course, these numbers have been slightly revised. But if you look at this and use this formula, -1, so we'll have a growth, which is coming to 31.1%. Okay, fine. So our was also coming to almost like 30%. So it is not a big change here, but this is another way of calculating the growth. Okay, so we have taken the average of 3 years. Now just use the step 3. Read this.
Step 3, use in PEG ratio. If Ultratech's current PE ratio is say 28, then PEG is equal to 28 by 31.1, which comes to around 0.90. If PEG is less than 1, it means potentially undervalued relative to growth. PEG is around equal to 1, fairly valued. PEG greater
So
than
now,
1,
he has taken
possibly
the P
overvalued.
ratio as 28, whereas the P ratio is close to about 40 something. Okay, fine. So that's why we are getting a very high number on this formula. He has assumed that the P ratio is just 28 without, because I have not given the number to the AI. So it just, thought that throughout this thing, that suppose it is 28, how the share would look like. Now, if it is 28, then we say the share is undervalued relative to the growth. So we should go ahead and buy it. Okay. So if it is more than 1, we say that it is trading at a premium to its growth. Okay. Fine. So any questions here? Anyone? So let's come back to this. So this is basically 31.82. Okay. Now here, if you use the formula, which, I just shown, you can even use that formula. So in your Excel sheet, I've given you the formula also. If you can just see today in the morning, I've uploaded. So now if you just see, this number's all been calculated. Okay. So I'm just going to tell you that assuming that these numbers were correct, because these numbers were plugged in about few months back, where, you look at the all these ratios. Okay. So we have the growth, we have the PEG ratio, we have the PE ratio, and other metrics. So based on that, without even going more in detail, so we say that the median PEG ratio of the industry is 1.6. So as a whole, all the industries is valued highly compared to, we can say it's overvalued or it is possibly overvalued, because all the companies are trading at a much higher PEG ratio. Okay. Now there's one more way of calculating. So we can calculate a forward P ratio. Okay, so I'm just saying forward P ratio. Okay, so we can calculate 1 year forward P ratio, 2 year forward P ratio, or a 3 year forward ratio. Sometimes if PEG ratios doesn't give you much of, so you say that it is very high, so we can just take is the this things the earning per share. So what we do is that you take the how do we calculate that? We take for P ratio we take the price, isn't it? Price upon earning. Fine. So price upon earning. So what we do is that we take the price. Okay, here. Okay. And we calculate here the price, and then we divide this by the earning per share of the company, which is, say 2 years forward, which is 469. And again calculate. So forward P ratio, 2 year forward P ratio is 26. Here what I have done, I have taken the market price per share today and divided by 2027 P ratio. So it is coming around 26. So we say that the company is growing, but it is going at such a fast pace that, looking at a forward P ratio, it may seems to be the company is cheaper. Okay. So similarly, we can calculate the forward P ratio for all the companies and calculate what is the median and then assess based on a 2 year forward P ratio. Fine. Have you got it, Srishti? So, sometimes
Yes,
we
sir.
calculate the forward P ratio, 1 year forward P ratio, 2 year forward P ratio. Of course, this is not a very good thing, uh, you know, uh, because, if you take a 2 year or 3 year down the line, forward ratio, and we are trying to assess, how the company, if, all these estimates are going to be true, then we can say the company maybe not be so highly valued. It may look today valued because people are buying. Why people are buying? Because they think the future is good for the company and company is going to show a very good profits. So instead of taking the current year profits or the trailing 12 months profit, we take the profits of 2027 or 2028 and try to again calculate the P ratio and see how does the P ratio looks like. Okay. And then we compare the forward P ratio of all the companies in the pack and see how it looks if and find out which is the cheapest company based on 2027 profits. Okay, fine. So that's another thing you can add. So forward P ratio, 2 year forward P ratio, and then you can compare. Okay, so then the last thing would be to calculate the beta. Now, beta is basically, do you know what is beta? Okay, so now, of course, I'll explain what is beta later on. So now we are going to end the lecture, but we are going to have an half an hour extended session. I will not close the lecture. What you do is you just complete this data, okay, for the cement companies in at the back end. Fine. And since we are going to cover up for another half an hour lost time, what is the time at which normally we close the lecture?